So what drove our fund performance last quarter? It was a strong quarter across the board. The Catholic Values Trust returned just under about 6%, and the Income Trust delivered about 1.09%. Both results were driven by a mix of strong equity returns and falling bond yields. The biggest driver of performance within the Catholic Values Trust were equity markets, with both the Australian and global markets delivering strong gains. And while the markets initially dipped following the Liberation Day tariff announcements, that weakness was actually short-lived, as many of those tariffs were later walked back and progress was made on trade deals. Investor sentiment turned around and momentum picked up meaningfully into the end of the quarter. Australian equities rose nearly 10%, led by strength in financials, real estate, and technology sectors. That rally was supported by a clearer trend of inflation, which helped shift market expectations around the rate cuts. And the market's looking like it's pricing in around 3 to 4 cuts before the end of the year now. The most recent May CPI also showed the declining trend, with the headline inflation and the trimmed mean both within the RBA's target range. Labour markets remained resilient, although some underlying weakness is beginning to surface. The latest labour force data showed some moderate job losses, a sign that the broader economy may be cooling. Global equities also performed well, and it was up 7.8% over the quarter, supported by strong returns in technology, communication services, and financials. The US markets reached new highs, helped by the solid economic data coming through, improving sentiment, and optimism around trade deals with China and the EU. There was also a lot of, continued optimism for AI-related themes, with the majority of gains driven by the so-called Magnificent Seven tech stocks. And although there was some renewed conflict in the Middle East late in the quarter between Iran and Israel, markets held up pretty well, and that was helped along, obviously, by the quick resolution of this conflict. Bond markets also performed well. Yields fell across the curve, with the 3-year government bonds down 44 basis points, 10 years falling about 22 basis points. So clearly investors have priced in the accelerating chance of RBA rate cuts over the next 12 months. On the income trust side, performance was pretty good, supported by consistent income from floating rate note credit and hybrid securities. Credit spreads it ended the quarter relatively stable, but spreads initially did spike following the Liberation Day announcements. They've since narrowed and recovered most of the earlier drawdowns. Hybrids remain in high demand from yield-seeking investors, and that's helped along with APRA sort of slowly phasing them out with this limited supply, sort of supporting the tightening in spreads. So overall, a strong quarter. The equities sort of delivered the lion's share of the gains, but bond and credit markets also made good contributions. And with the inflation easing and rate cuts firmly back on the radar, I think the outlook remains quite constructive for diversified portfolios. In terms of positioning, we continue to maintain a defensive positioning across portfolios. Equities remain underweight, as there is still a degree of uncertainty around the consumer, inflation, global growth risks, particularly around US tariffs and China's recovery. And while valuation in some sectors have moderated, others remain stretched, especially within large cap financials and technology. Our fixed income exposure remains overweight. The RBA is expected to continue its easing cycle in August, and due to uncertainty around tariffs, we think high quality bonds continue to provide income and diversification. And especially as term deposit rates begin to drift lower, we believe the case for an overweight bond allocation remains strong. Our investment process remains adaptive to the near-term developments, but we're still firmly aligned to our long goals. In terms of the 3 key reasons why we believe the Catholic Values Trust and Income Trust remain compelling investment options. 1 is for strong yield. The Income Trust remains suitable for yield-focused investors. We offer strong income through a diversified mix of fixed interest and hybrid securities. And with term deposits continuing to decline, the trust continues to deliver returns of at least 1% above cash. Number 2 is our values-driven investing approach. We invest with purpose, guided by a Catholic values framework that excludes harmful sectors and favours ethical, responsible companies. The Catholic Values Advisory Board also provides independent oversight to ensure that alignment with Catholic social teaching. And 3, our balanced and dynamic approach to investing. Our portfolios are diversified and actively managed, not set and forget. We adjust our positionings often based on the economic and market developments. We're able to protect capital in volatile environments, but we're also ready to capture opportunities as they emerge.
Equity Trustees is the responsible entity for the Catholic Values Trust and Income Trust, and neither SG Hiscock & Company, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as an indicator of future performance. You should obtain a copy of the information memorandum before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.